what do you think this is?
Pardon me?
What do you think this is?
Well,
plain vanilla recession, typical cycle?
Yeah,
how does Oaktree or you think about it?
I think it's going to be a moderate recession. And by the way, that's one of the many forecasts I don't believe. But nobody thinks it's going to be an economic cataclysm. Among other things, if the normal description of a cycle is boom bust, we didn't have a boom in the real economy.
Right.
We had the longest economic recovery in history of exceeding 10 years during this period I'm talking about, but it was also the slowest. So we didn't have a boom. Where you had excesses, perhaps were in leverage finance, and so equity investors will lose money, and junior debt holders will lose money. I think that's what's going to happen.
So, are you excited, for the, transitioning from a decade where growth did well and value did not, and feels like we're rounding into the perfect opportunity zone for Oaktree?
Well, I don't want to jinx us, but the truth is that the period I described. Look, if you look at 2009 through 21, you had low and declining interest rates thanks to no inflation. You had a healthy economy stimulated by the Fed. You had a paucity of defaults and bankruptcies. You had no real fear. The greatest fear was the fear of missing out. Nobody was afraid of losing money. You had happy asset holders, eager buyers, easy access to capital. So you put that together, that's a pretty glowing period. And of course, the trouble is that idyllic periods like that encourage risk-taking.
Right.
So people push up their LTVs and try to limit their equity, and they become willing to engage in riskier assets. And one of the interesting hallmarks of the last 15 years was, prior to 15 years ago, I think you couldn't issue a bond for a company that lost money. And in the last 15 years, it became possible. Prior to 15 years ago, the private equity industry, for the most part, would not invest in technology or software. And then they said, well, maybe it's okay. And so you have a lot of tech and software that was the subject of LBOs, for which a lot of debt was raised. And these things will be tested. Buffett says it's only when the tide goes out that we find out who was swimming naked. And the tide, we believe the tide will go out. So we're very optimistic.
Yeah.
The 13 years I'm talking about were a tough period. Well, it was a great period for asset owners and borrowers. It was a terrible period for lenders and bargain hunters, which is what we are at Oaktree. That's what we consider ourselves to be. And, the distressed debt funds, 35-year record, gross return of 22% a year, unlevered. Now, if you can make 22% a year on unlevered investments, it gives you a sense for the bargains we were able to secure. That's how you make that kind of money. The value investor, his goal is to buy things for less than they're worth. Makes perfect sense. Yeah. They're most commendable, right? But the trouble with that is that it requires the cooperation of somebody who's willing to sell an asset for less than they're worth. And that happens in the bad times. That happens when people say, I bought it at 100, it's 50 now, I got to get out before I lose the other 50. And things will never get better. That was not the case in the 13 years. So we had a hard time accessing bargains, and the funds in that category, for example, had the worst stretch ever. Now, they all earned at least 10, which is not the worst thing in the world, but it was far from our long-term average. Now we think we have a shot at the long-term average again, because we think that there will be motivated sellers, forced sellers, and those are the people you want to buy from.
So you're saying that we're entering the 20% zone?
For us, yes, I think so.
Really?
Well, I think so.
And are we there now, or you think
No,
we're getting
we're
there?
not there yet.
Right.
You need desperation.
And how will we know that when we see it?
We'll be buying. No, I mean, look, I actually argue for an activity that I describe as taking the temperature of the market. You have to assess the mood of the market participants. Are they happy and celebrating and, putting down orders at the Ferrari dealer? Or are they, hunkering down and, telling their wives they can't go shopping? And we'll know, we'll know when people are suicidal.
I don't think our real estate guys are quite there yet.
No. Well, you and I were talking before we started about denial, and
I didn't say that.
And well, look, and what happens in illiquid assets, what happens in the liquid markets, the listed markets, is that prices collapse. What happens in the private markets is that there are no transactions, right?
Right.
Because the buyer wants a price which is commensurate with current conditions, and the seller hasn't accepted that yet.
Right.
So obviously there's no meeting of the mind, there's no transactions. And usually, after a while, somebody has to sell for any of a variety of reasons, and that's when the prices of private assets decline. There's been a big discussion of last year was one of the worst years on record for the stock market, and first or second worst year on record for the bond market, and maybe the worst year on record for the 60-40 mix of stocks and bonds, and yet most private investors didn't mark down their portfolios much, if anything. So there's been a discussion of the propriety of that relationship, and every private asset owner has an explanation for why they haven't marked them down.
Yeah, I've heard a few.
And I want to interject here that they're not all nuts, because the argument is that private assets have not shown enough volatility, but I would submit that public assets exhibit too much volatility. And when you mark your private portfolio, the decision rule can't be set a price which is commensurate with the doomsday thinking that's prevailing in the public markets. That's not the right idea either.
So that's